The acquisition and payment cycle is a fundamental aspect of any business. It encompasses the process by which companies purchase goods and services to support their operations and fulfill their obligations. This cycle, from requisition to payment, is critical in auditing. It provides a window into a company's financial health, internal controls, and overall compliance. Auditors scrutinize this cycle to ensure that financial statements accurately reflect the company's transactions. Understanding the flow of transactions within this cycle allows auditors to assess the risk of material misstatement. By examining each stage of the acquisition and payment cycle, auditors can identify potential vulnerabilities. This helps to create a comprehensive audit plan. This essay will delve into the intricacies of auditing the acquisition and payment cycle. We'll explore the significant accounts, disclosures, and assertions involved. Additionally, we will examine the different types of risks, inherent, fraud, and control that auditors must consider. Finally, we will discuss the audit procedures employed to mitigate these risks and ensure the accuracy and reliability of financial reporting. The acquisition and payment cycle touches upon numerous accounts within a company's financial statements. These accounts, representing various stages of the procurement process, are meticulously examined by auditors. Among the most significant accounts are inventory, accounts payable, and expenses. Inventory represents the raw materials, work in progress, and finished goods held by a company. Accounts payable reflects the short-term obligations incurred for goods and services received but not yet paid for. Expenses encompass the costs associated with generating revenue, including the cost of goods sold and operating expenses. These accounts are intricately linked, with transactions flowing from one to another throughout the cycle. In addition to these accounts, certain disclosures are crucial for providing a complete picture of a company's acquisition and payment activities. These disclosures offer transparency into the company's financial reporting practices and risk management strategies. For instance, companies must disclose their accounting policies for inventory valuation, accounts payable recognition, and expense allocation. Furthermore, disclosures related to significant suppliers, payment terms, and any outstanding litigation involving the procurement process are essential. These disclosures provide context and allow stakeholders to understand the potential impact of these factors on the company's financial position. Assertions are the implicit or explicit claims made by management about the recognition, measurement, presentation, and disclosure of information in the financial statements. These assertions form the bedrock of auditors' work. They provide a framework for designing and performing audit procedures. By testing these assertions, auditors can obtain sufficient appropriate audit evidence to support their opinion on the fairness of the financial statements. In the context of the acquisition and payment cycle, key assertions include existence. This assertion relates to whether the recorded inventory, accounts payable, and expenses actually exist. Completeness. This assertion ensures that all transactions and events that should have been recorded are included in the financial statements. Rights and obligations. This assertion confirms that the company holds the rights to the inventory and is obligated to pay the accounts payable. Valuation and allocation. This assertion focuses on whether inventory, accounts payable, and expenses are recorded at appropriate amounts and allocated to the correct periods. Auditors use a variety of procedures to test these assertions, including inspection of documents, confirmation with third parties, and analytical procedures. The specific procedures employed will depend on the auditor's assessment of risk and the nature of the entity's operations. By obtaining sufficient appropriate audit evidence, auditors can conclude whether the assertions made by management are fairly stated. This, in turn, provides a basis for their opinion on the fairness of the financial statements as a whole. Inherent risk in the context of auditing refers to the susceptibility of an assertion to a misstatement that could be material, either individually or when aggregated with other misstatements, assuming there are no related controls. This risk is inherent in the nature of the account or transaction and exists independent of the audit. Several factors contribute to inherent risk in the acquisition and payment cycle. The complexity of the company's operations, the nature of its industry, and the competence of its personnel all play a role. For instance, companies with complex supply chains involving multiple vendors and international transactions face a higher inherent risk of errors or fraud in their procurement processes. Similarly, companies operating in industries subject to significant price fluctuations or technological advancements may experience a heightened risk of inventory obsolescence or impairment. The competence and integrity of personnel involved in the acquisition and payment cycle also significantly impact inherent risk. Inadequate training, lack of experience, or a weak control environment can increase the likelihood of errors or fraudulent activities. Understanding these inherent risks is crucial for auditors. By assessing the factors that contribute to inherent risk, auditors can tailor their audit approach to address the specific risks present in the acquisition and payment cycle of the entity being audited. Section 5. Fraud risks, unmasking potential deception. Fraud risk, a specific type of risk, represents the risk of material misstatement in the financial statements due to fraud. This risk encompasses two primary categories: fraudulent financial reporting and misappropriation of assets. In the acquisition and payment cycle, misappropriation of assets is a greater concern. Misappropriation of assets in this cycle can manifest in various forms, including fictitious vendors. Perpetrators may create fictitious vendors and generate invoices for goods or services never received. Inflated invoices. Employees might collude with vendors to submit inflated invoices, pocketing the difference. Unauthorized purchases. Individuals with purchasing authority could make unauthorized purchases for personal gain. Several red flags can indicate potential fraud in the acquisition and payment cycle. These include unexplained variances between actual expenditures and budgeted amounts, transactions with vendors lacking proper documentation or approvals, significant increases in purchases from new or unknown vendors. Auditors are trained to be skeptical and to consider the possibility of fraud when designing and performing audit procedures. They employ a combination of techniques to detect fraud, including analytical procedures, tests of controls, and substantive procedures. Section 6. Control risks, safeguarding against errors. Control risk is the risk of a misstatement that could occur in an assertion about a class of transaction, account balance, or disclosure, and that could be material either individually or when aggregated with other misstatements, will not be prevented or detected and corrected on a timely basis by the entity's internal control. Essentially, it's the risk that the company's internal controls fail to prevent or detect material misstatements. In the context of the acquisition and payment cycle, effective internal controls should address key risks such as unauthorized purchases, inaccurate inventory records, and erroneous payments. Controls should ensure that all purchase requisitions are properly authorized and supported by legitimate business needs. Controls should ensure that inventory is properly received, counted, and recorded to maintain accurate inventory levels. Controls should prevent duplicate payments, payments for goods not received, and unauthorized changes to vendor master data. Robust internal controls typically involve a combination of factors. Separating purchasing, receiving, and payment authorization responsibilities reduces the risk of a single individual perpetrating and concealing fraud. Establishing clear authorization levels for purchase requisitions ensures that expenditures are reviewed and approved by appropriate personnel. Reconciling vendor invoices with purchase orders and receiving reports helps ensure that payments are made only for authorized goods and services received. By implementing and maintaining effective internal controls, companies can significantly mitigate the risk of material misstatements in their financial statements. Section 7. Preliminary Analytical Procedures, Early Detection. Preliminary analytical procedures are an essential component of the audit process. They involve analyzing financial and non-financial information to identify unusual trends, fluctuations, or relationships that may indicate a heightened risk of material misstatement. In the acquisition and payment cycle, these procedures provide auditors with a broad overview of the company's purchasing and payment patterns. This helps to identify areas requiring further scrutiny. Common analytical procedures used in this cycle include trend analysis, ratio analysis, and reasonableness tests. Comparing current year balances and ratios to those of prior periods can reveal significant variances that warrant further investigation. For example, a substantial increase in the accounts payable turnover ratio could signal potential cash flow problems or aggressive payment practices. Evaluating key ratios such as the inventory turnover ratio, the gross profit margin, and the days payable outstanding can provide insights into the efficiency and effectiveness of a company's procurement and payment processes. Developing expectations for account balances based on industry benchmarks or non-financial data such as the number of employees or units produced can help auditors identify potentially anomalous figures. The results of preliminary analytical procedures guide the auditor's risk assessment and help tailor the audit plan by focusing on areas identified as high risk. For instance, if analytical procedures reveal an unusual spike in purchases from a particular vendor, the auditor may choose to perform more extensive testing on transactions with that vendor. Section 8. Responding to risks, a tailored approach. Once auditors have identified and assessed the risks of material misstatement, they develop and implement audit procedures to address those risks. The specific procedures employed will depend on the nature of the identified risks and the auditor's assessment of the effectiveness of the company's internal controls. If the auditor determines that the company's internal controls are designed and operating effectively, they may choose to rely on those controls to reduce the risk of material misstatement. In this case, the auditor will perform tests of controls to obtain evidence that the controls are functioning as intended. Tests of controls may include inquiry, observation, inspection of documents and records, and reperformance. If the auditor determines that the company's internal controls are not effective, or if they choose not to rely on those controls, they will perform more extensive substantive procedures. Substantive procedures are designed to obtain direct evidence about the assertions made by management in the financial statements. In the acquisition and payment cycle, substantive procedures may include confirmation of accounts payable, inventory observation, examination of supporting documentation, and cut-off testing. By performing a combination of tests of controls and substantive procedures, auditors can obtain sufficient appropriate audit evidence to support their opinion on the fairness of the financial statements. Section 9. Conclusion. Ensuring trust and integrity. The acquisition and payment cycle is a critical area of focus in the audit process. By understanding the significant accounts, disclosures, and assertions related to this cycle, auditors can effectively assess the risk of material misstatement. Identifying and evaluating inherent risks, fraud risks, and control risks allows auditors to tailor their audit approach and select appropriate audit procedures. Through preliminary analytical procedures, tests of controls, and substantive procedures, auditors gather sufficient appropriate audit evidence to support their opinion on the fairness of the financial statements. This rigorous process of risk assessment and evidence gathering is essential for ensuring the accuracy and reliability of financial reporting. Furthermore, ethical decision-making is paramount throughout the audit engagement. Auditors must maintain independence, objectivity, and professional skepticism to provide an unbiased and impartial assessment of the company's financial reporting. By upholding the highest ethical standards, auditors play a vital role in maintaining public trust in the capital markets and promoting the integrity of financial information.